You've probably heard the phrase the business cycle a lot thus far in your career, whether it be in your economic textbooks or your finance textbooks when you were in school. You probably see commentators on CNBC talking about it. You probably read about it in the Wall Street Journal. But what I've noticed is a lot of people don't take the time to actually explain what is the business cycle? What does it mean when we talk about the phases of the business cycle? Well, that's what we're going to cover in this video. So we're going to go through each of the 4 phases in the business cycle, and we're going to talk about how key economic data series, such as inflation, employment, economic growth, the stock market, you name it, perform during those periods. And then at the end, we'll give you some key tips on how you can invest around the business cycle. So let's get right into it. Here, the textbook business cycle. Now that's important because we're going to talk about how it works in reality near the end of the video. But the textbook business cycle follows a 1, 2, 3, 4 pattern. So you can see the 4 business cycle phases that I've listed here on the right. We have expansion, we have the peak, we have recession, we have trough. And so you might see here, it's broken into 2 categories. So we break it down even further. Expansion versus contraction. The first 2 phases are the expansion phases, and the last 2 phases are the contraction phases. But what does that mean? What is actually expanding and what is actually contracting? What does this line that you've seen that goes up and down, actually represent? Here we tell you it's LEIs, but put more simply, the business cycle is the natural rise and fall of economic growth over time. So when we talk about LEIs, what we're really talking about is anything that can be a proxy for economic growth. And that's what you see on this slide here. I include a list of some of the things that are in the leading economic index. Now you can see there's things like the New Orders Index, building permits, the S&P 500, consumer expectations. There's a wide list of potential proxies of growth that you can use. We tend to use the ISM Index as we think it's a bit cleaner. And as we move forward, that's sort of what we'll be referencing. So let's kick it off here. Phase 1, the expansion phase. So each of these, I'm going to cover the 4 phases, but it's important to remember that each phase plays into the next. So whatever's happening in the phase that we're talking about is a result of something that was happening in the phase before, and it's going to impact what happens in the phase afterwards. So just because I'm starting in phase 1 doesn't mean we're just starting from scratch. What's happening in phase 1 is a direct result of what was happening in phase 4. So I really could have started this at any point in the business cycle. It just makes sense in my head to start at phase 1. But when we do get to phase 4, I want you to take a second to remember that we're then going to flow back into phase 1. So this isn't just starting in a vacuum. All right, let's kick it off with the table. So the ISM index up top, that's how we're going to start every single one. And this is what you can sort of measure by the line. So ISM index, or a proxy of economic growth, as we can see, that is starting to rise. So we are just finishing coming out of the recessionary period, out of the trough, and we're starting to see an acceleration of growth. And so what is that shown by? That is the ISM index starting to rise. At this point, the unemployment rate is falling and inflation is low, but it's starting to rise. And so what you basically see is the Fed has just started cutting rates in phase 3 and 4. And you sort of get the result of that back in phase 1. So inflation, because growth was contracting leading up to this, is low. And the unemployment rate has been falling as the rate cuts start to work their way through the economy. So this is a great period of low unemployment and low inflation, but it is starting to rise. Because the same way as the rate cuts are working their way through the economy, causing the unemployment rate to fall, that same mechanism is causing inflation to start to rise as economic growth starts to rise. So again, interest rates would be low. Consumer confidence is strong and rising. Again, inflation's low, stuff has been cheap. Wage growth is starting to rise and business investment is starting to rise. Money is cheap, interest rates are low. In general, people start to feel really good about the economy at this period. This is where we start to see, it's called the expansion phase. I don't know if I need to explain it much more than that. Economic growth is positive and accelerating during this period, and all of the indicators start to look really, really good. And that leads us to phase 2, or the peak phase. This is where the ISM index starts to near its peak. So it's still moving higher, but the rate at which growth is accelerating starts to slow. At this point, the unemployment rate generally will hit its lowest point. Inflation is rising and eventually peak. So inflation can be pretty elevated at this point. Interest rates are also starting to rise, generally speaking. So the Fed, in response to the unemployment rate being at its lowest point and inflation starting to rise and being at a pretty elevated level, will generally start to hike interest rates. This is where consumer confidence is near its very highest. So again, we've just had a period of prolonged economic growth. So the consumers are feeling really good. Wage growth is the strongest, and business investment is still growing. Everyone's feeling good, but it's starting to slow. The rate of business investment growth is starting to slow. That leads us to phase 3, the recession phase. So at this point, this is where you start to see the beginning of the decline in economic growth. So the ISM index turns lower. At the same time, unemployment rate starts to rise. This is when the inflation rate is peaking. Interest rates are stabilizing. So a lot of times the Fed has hiked rates to a certain degree to fight off inflation and to prevent a substantial rise in the unemployment rate. And this might be where you see a little bit of a pause as those rate hikes work their way through the economy. Consumer confidence is eroding. Wage growth often starts to stagnate. Now, important caveat, wage growth generally won't turn negative, so you don't see pullbacks in wages for the most part. But at this point, you do see wage growth start to slow. So it's still positive, but it's growing at a slowing pace. Then you see business investment, which does start to contract. And this is often because, again, we're talking about interest rates that have been rising. Money's a little bit more expensive. Businesses are starting to slow down their investment, especially as uncertainty is beginning to rise. And that leads us to phase 4, the trough phase. This is when a lot of stuff hits its lowest point. This is the flashing red on CNBC phase, you might want to say. So the economic growth hits its lowest point. The unemployment rate hits its lowest point. Inflation hits its lowest point. That might be counterintuitive, right? That unemployment rate and inflation rate are hitting its lowest point at the same period of time. Sorry, the unemployment rate is hitting its highest rate. That's why it's counterintuitive. So the unemployment rate is hitting its highest point, and inflation rate is hitting its lowest point. So as businesses stopped investing, they stopped hiring, causing the unemployment rate to move higher. Inflation at this point hits its lowest point because economic growth hits its lowest point. So you're not seeing these same price increases. And then the interest rates are starting to decline. So this is where interest rates are being cut. The Fed is cutting interest rates to try to fight off the increase in the unemployment rate. And they're less worried about inflation because inflation is low and economic growth has contracted. Consumers don't feel great. This is where it hits its lowest point. Wage growth is very weak. Again, I say weak. It doesn't really contract ever. But it might be flat to slightly positive. And then business investment starts to stabilize. So as interest rates are coming down or declining, businesses start to say, hey, money's cheap again. There's a lot of available labor, right? The unemployment rate is high. Maybe this is time to start that new project. And so I provided this table here. I'm not going to talk through this table. It's just a combination of all of the little tables that have been on the last few slides. If you want, pause the video here, take a screenshot. I keep something like this sort of printed out next to my desk. I think it's very, very helpful as I'm going through the key indicators and I'm trying to figure out where we're at in the business cycle. Being able to refer to this often helps me. So pause the video, take a screenshot. I think this is a very, very helpful table. And so the moment I assume we've all been waiting for, how does the market perform during these periods of time? So we went back through the last 9 business cycles and sort of looked at the S&P 500 and how it performed. We combine the first 2 phases into something called risk on. And during that period, the S&P 500 has been up 8 out of the last 9 times, sorry. And the average return is 30%. It was a very good time to be owning the stock market. And again, this requires you buying at the end of phase 4, the beginning of phase 1. So when consumer confidence is the lowest and everything looks not that great, right? So it's easier said than done to pull the trigger at that point. But if you're able to, and you're able to ride out both of the expansion phases, you generally see a pretty good return. We then move on to the risk off phase, and that's really just a coin flip. So S&P 500 up 4 out of the 9 times, the sort of 9 business cycles that we looked at. Slightly negative average return. A lot of times this is where people say stock picking can be very, very helpful. The market's going to be relatively flat, but there's going to be some winners, there's going to be some losers. So if you can pick the right sectors, which we'll talk about on the next slide, you can still do well in this period. But the overall market, generally flat. Again, typically, generally, I'm going to use that language this whole time. And then the risk aversion phase, or phase 4, for the most part, we almost see the exact opposite of the risk on phase. So S&P's only been up 1 out of 9 times, and the average return is almost negative 20%. So again, this is the flashing red lights and graphics on CNBC phase, I like to say. So sounds easy, right? You buy during the risk on periods, you start to sell during risk aversion, and then in risk off, you're not owning anything and you're waiting for that perfect moment to buy right before risk on. But remember how I said that the textbook business cycle is not exactly how it actually works? That's because in theory, the business cycle goes 1, 2, 3, 4. But in reality, that's often not how it works. You'll see 1 to 2 to 3, back to 2 to 3 to 4. There's often mid-cycle slowdowns. As you can see here, we use the ISM New Orders Index to talk about 2 different periods of time. You can see from 96 to 2000, 2001, there's a little bit of a head fake in the late 90s, where the ISM started to turn lower before quickly reaccelerating prior to the real turn down. So those who were following and just assumed it goes 1, 2, 3, 4, in about 1997, you would have got caught off guard as the ISM turned lower. You're like, okay, we're on to phase 3. This is where the market's kind of flat. I'm going to get ahead of the risk off phase where the market doesn't do so well. So I'm going to lower my equity holdings. You're feeling pretty good. And then all of a sudden in 98, you get that reacceleration, right? We're back to phase 2. So it's really, really difficult to actually find the inflection points of the business cycle when we're moving from one phase to the next. Now, I could make a video that was 30, 40 minutes long covering how we try to anticipate the actual inflection points and what we look at, but I'm going to direct you to the macro specialist designation or our macro investing boot camp. If you're looking to learn more about that, we cover those things in depth and we give you tools to find out what's a head fake and what is an actual inflection point. So if you're looking to go deeper into this topic and learn how to make those investment decisions, I suggest checking that out. And the other thing that we teach you to do is the sectors that perform well during these periods and why they perform well. So I give you a little bits of hints here. So it goes from deep value to cyclicals, to stability and growth, to defense and risk aversion. But again, the important thing here is, where are those inflection points? What is the point where you should be shifting from cyclicals to stability? What is the point where you should be going to stability to defensive? And probably most important, what is the period where you should be going defensive to the deep value names that generally perform well in risk on? So again, this is what you learn in the macro specialist designation or our macro investing bootcamp, how to make these investment decisions around the business cycle and how to find and anticipate the actual inflection points. And I'm going to leave you with that today. I hope you enjoyed this video. Happy Monday. Have a great week. And I will see you next week right back here with another educational video.